Hey guys, welcome back to Financial Markets. Hope you're all doing well in this quarantine. So, interestingly, this past week we had oil. For those of you that I'm sure have at least been watching it or heard in the news, turn negative for the first time. And so a lot of people are confused, especially the retail investors, about what actually happened. What does it mean? So I thought this video will be quite useful and good to sort of explain a little bit about that. And for the retail investor out there that's currently holding into some ETFs or oil related products, it would be a good idea for you to actually know what oil is trading at, and to sort of explain why and what happened actually when it turned negative. So firstly, this was a futures contract. So for those of you that don't know what futures are basically a derivative product which essentially allows you to take, in this case for oil in particular, allows you to take a physical delivery of oil at a future date at a given price. So for an example, if I buy a June, so with this one here is a June future. So if I buy a June future, currently trading at $17 of a contract, and the US oil spot might be trading at $30. So me being an oil physical holder, I might say, well, okay, I need to hedge out my risk, because if oil goes down to $17 a barrel, I'm going to lose money on the contract. I'm going to lose money on oil, because it should be worth 34 right now, but in the future it'll only be worth 17. So what I would do is I would go into the futures market, and I would say, for example, in this case, go long the future. And the reason why I would go long the future is because it allows me to take delivery of oil at $17 a barrel. So naturally it's trading at a discount. So I might say, okay, I've got a lot of storage space. I'm going to buy oil next month, take delivery at $17 a barrel, and then I can potentially sell it on at the time in the marketplace for $20, $30, whatever it's trading at. And the reason why you could do that, and so you might question, say, well, why is the future trading less than the spot? Well, the reason why it's trading less than the spot is because oil has been obviously, because of this coronavirus and supply chains, everything disrupted. A lot of oil is sitting in basically storage houses. And so what happens is when you take physical delivery of oil, you have to sign up and get a lease and get a space in one of the storage facilities. But naturally, because people are unable to export their oil out right now, they're having to just store them. So there's a lack of complete storage. In which case what's happening is that people are having to dump the futures contract right before expiration, because naturally they cannot take physical delivery of oil because they have no place to store it. So historically, you would have obviously these big, companies like BP, Shell, and so on. That's why always closer to expiration, you would never have a problem as an investor getting out, because you'd always have those companies buying it, because they could store their oil and they have to take physical delivery. But now even they're struggling to do so. So I think it'll be good. So if you look at this chart here, this was the May contract, and you saw the May contract literally plummeled from $27. Right, let's see if we can get data here. So on the 9th of April, and then it went all the way down to minus $40 a barrel. Now what does that mean as an investor if you were long that future? So if you were somebody who had that future, you would have to now pay somebody to get it off their hands. So for an example, I bought $2,000 worth at $20 a barrel. So if it goes to zero, I lose the entire $2,000. So I lost all of that, but now I'm losing more than what I've even invested, because now if I want to get off my hands, I have to pay $30 a barrel, a contract, to the investor buying it from me. So an example, we have say 10 contracts. So if you have 10 contracts that you bought at $220 a share, that's 20 times 10, which is $200. So it goes to zero, you lose your $200, so you lost all of that. But now, the 10 contracts, if you want to get off your hands, is trading at minus 40. So minus 40 times 10 is minus 400. I.e., you have to pay somebody another £400 to actually sell your contract to them. And the reason why it turned negative is coming back to the point is because nobody has storage facility. So nobody wants to hold that contract to expiration because they cannot take physical delivery of oil because they have no place to store it. So that's why oil had plummeted into negative territory. Now that doesn't mean that oil is now trading at a negative value. If you go out to the petrol station, you're not going to get paid to put petrol into your car. It doesn't work like that. These are just derivative products. So these are actually products that are traded in the in the exchange by these institutions and retail investors even to give you exposure to oil, and that's the idea of it. So it's completely a market participant game, right? It's a buying and selling story rather than the actual physical underlying of the oil price itself. And so as you can see here, massively plummeted down to 40%, and a lot of people went bust, and not just retail investors, but actual institutions and hedge funds that were had oil and they couldn't get rid of it. Now, for people that did have storage space, which there wasn't very many, for them it was a great buying opportunity because you can buy it now. You can get paid to buy it. So again, somebody has to pay me. I get paid £400 to buy 10 contracts worth of oil. I buy it. So I pay nothing. I get paid 400, and then I use that to, fund my storage costs if I have a storage facility. And then come next month in the June period, so this is a June contract trading. If it closes at $17, I can sell it to the guy who's now buying the $17 contract, and I can sell him $17 a share. And so I make a lot more money out of it if I have had storage capacity. So it's been really interesting week, and I know a lot of people have been confused about what's going on. So I'm really happy to answer any questions because, I have heard a lot of people, or I think it was about 4 billion worth of exposure in some ETFs, which definitely quite worrying because naturally for retail investors, they don't really have an idea of what they're buying. And I think it's important for them to know what they're doing, and because you don't want to lose your entire fortunes, right? Based on one contract. So there were I think the oil ETFs that are now going into liquidation. So I don't know if if one of you that are watching are part of these, but let me know if you do have any questions. I'm happy to answer them because it is turbulent and tough times for everybody. But I could hopefully give some professional when trading advice as to what to do. But for anyone who's not in oil and now watching all this, please stay out of it. There is no point trying to be a hero and trying to say, okay, I can flip it from minus 50 to 20 or whatever. It's not going to happen because the market might not even let you get out of it. So be careful out there, stay safe, and I'll see you guys in the next one.